Hi and welcome to today's video. Today I will be speaking about something that's very important, and that's profit-taking framework, especially as we are nearing the end of this current crypto cycle. Maybe this time will be different, but until proven otherwise, I like to take lessons from the history. Before we start, disclaimer, nothing here is a financial advice. I'm just one person with a microphone. Always do your own research. To discuss what could potentially happen, I will look at previous cycles, especially Bitcoin halving cycles, and to see how they unfolded. And also I will be discussing why this time could be different and what are potential events that are different today compared to the previous cycles. Let's start with previous Bitcoin halving events. Specifically, we had 4 till now: 2012, 2016, 2020 and 2024. For today's video purpose, I will be discussing 2 Bitcoin halving cycles, 2016 and 2020. What they have in common is like that they had 3 green years followed by a bear market year. In 2015 it was a pre-halving year, it was green year. 2016 was a halving year, and post-halving year the strongest year was 2017, and after that followed, as you can see, 2018, which was a bear market. Then the next cycle we had a similar, or should I say exact scenario. 2019 was a pre-halving year, 2020 was halving year, and 2021 was post-halving year. Those were the green years, and 2022 was again the bear market. Going to the recent cycle, 2023, 2024 and 2025 are also green, at least for 2025 we can say it for now. And if we follow the same logic as the 2 previous cycles, 2026 should be most challenging year for the Bitcoin when comparing the previous 3 years. And now I will discuss why this time could be different. First, we have Bitcoin ETF's approval, and they in January of 2026 it will be 2 years since their approval. And if we compare it like with the gold ETF approval, which is the upper picture, we can see that after the gold approval, or to be exact, after the gold ETF's approval, what gold went through is a multi-year bull run. It had some pullbacks during that bull run, but you can see that overall the trend was upwards. So if Bitcoin were to follow that trajectory, that would mean that we are also meant to go to the multi-year bull run. And this is one example or one reason why this time could be different. Another reason is like what is shown by picture below, that we are now in the rate cut cycle. Yes, it's true, we are having inflation that's accelerating at the moment, but for now the employment is weakening, so that's the reason why we have the new rate cuts upcoming. And we can see the latest upcoming meeting that there is a 96% chance that there will be at least 25 basis points cut. Another thing why this time could be different is that before I didn't see a lot of commercial media talk about national debt as I am seeing recently, and Bitcoin acting as a potential hedge against that debt. Yeah, we see here on the picture the current US national debt, but the situation in the rest of the world is not better. So this use case really plays its card. Then Bitcoin could easily continue to perform well because it's becoming more and more not just institutional but world asset. And now, like, what would be my plan? My plan would be to, by end of the year, by taking in consideration that this time is not different, I would sell 1/3 of my bag, and the condition is that it keeps making new all-time highs, and I would keep 2/3 for the long run. And now we can jump to the altcoins plan. When speaking about altcoins, first thing that we need to make sure is, like, when I speak about Bitcoin is in separate basket. Bitcoin is the king, all the rest are in other baskets. So why it's not good to hold them for the long run? We can see in the potential drawdowns, like for example Bitcoin in 2018 had 84% drawdown, while in 2022 had a 77% drawdown. And if we take Ethereum for the blue chips amongst altcoins, we can see that it had 94% drawdown from the local highs in 2018 or 81% in 2022. Is example of an altcoin when we go down more the risk curve of the altcoins, and we can see that in the both cycles it has 90+% drawdowns. And that's, for me at least, why it makes sense to sell altcoins and to have a plan, because like it's a pretty big possibility that after this cycle ends that we could see 90+% drawdowns. Also, why this time could be different is because we have developments. We could have in the future the altcoins ETFs approval. For example, Solana, Ethereum is already approved, and this could also change a picture how this cycle unfolds. And now when we have some feeling about how previous cycle unfolded, we can go to the one example of profit taking strategy. For example, one token that I hold that is of my interest is Kamino. First, I made assumption that Kamino is trying to be what is Aave trying to be on the Ethereum, and I watched at the maximum market cap that Aave made during its existence, and it was around 9 billion. And I said, like, I think that Kamino on Solana can achieve at least 50% of maximum market cap of Aave protocol, and that would give theoretical price of $0.5. And if we assume that entry price is $0.1 and quantity, for example, is 10,000 tokens, what is good to do in this case? Yeah, you have a theoretical price, theoretical target. For example, what would happen if you hit 0.4 and you don't sell anything, and then it reverses and it goes down 90%? That wouldn't be good feeling. So that's why, like, the first thing that I would do to have layers taking profit. And for example, this would be like that. I would set multiple layers. For example, if my target is $0.5, I would set, for example, the first layer taking profit at 0.25 for Kamino, which is the previous all-time high. And then I would sell 10% or 1,000 tokens. Then the second target would be around 0.4, where I would sell another 1,000 tokens. And then if it reaches 0.5, great. If it doesn't reach, by having those layers, and I already sold 20% of my bag, I successfully reduced my risk exposure. And now let's say everything is nice and we have a nice cycle and we reach $0.5, and then you have decision to make. You can sell the rest of the bag completely, or you can sell it just partially. If you sell it completely, you would sell the rest of the bag, which is 8,000 tokens times 0.5, it gives you $4,000 total value. And when you add the value that you sold before on the earlier layers, you get in total that you had $4,650 in total value. And if you hold everything till 0.5, you would make in total $5,000. With this, I want to say that you are not leaving that much at the table by implementing layer taking strategy. And another way that you could approach if you reach the $0.5 is that you sell, for example, 3,000 tokens, and you leave a half if we, for example, enter the banana zone of the crypto cycle. If this cycle is really like none other, then you can leave the 50% of your bag and sell in the upper layers. What I showed you here, 0.6, 0.7, 0.8, 9, and $1, you sell everything. This is just example. You made your benchmark against what you will measure it, you make your layers, and then you put it in place. Why is this important? Because when the mania arrives, you are ready just to execute on your previous plan, and it's important to stick to the plan. Another aspect that's important for this is time factor. When speaking about cycles, what I mentioned before, like if we follow the previous cycles, it should end around at latest at the end of December of 2025. And by taking time factor in consideration, you really have three choices. If it doesn't hit my target at the end of the 2025, I can sell everything, I can leave everything, or I can partially sell in case the cycle prolongs. In my example, I would choose the third solution. Why? Because then again, I'm respecting, if this time is not different, I will reduce my exposure by half, for example. And if it's different, I will still leave something on the table so I can be able to follow this new unfolding cycle. And based on what I presented till now in the video, we can make following conclusions. First, we can learn from the history, but we need to act in the present. Past cycles provide valuable context, yet decisions should also account for the current market landscape. Second, plan for both scenarios. Have a strategy in place for if history repeats, and an alternative if it doesn't, so you're never caught without options. Build a layered exit plan, combine price-based profit taking with a clear time horizon to balance upside potential and risk management. And last, stay adaptable. If fundamentals shift or stronger competition emerges, don't hesitate to change course. Preserving capital is always more important than loyalty to any single asset. This is it for today's video. So if you want to have a comprehensive overview of what I was speaking about, and you're more of a person that likes to read with a tea or coffee, you can check my Substack, and maybe you will find some other topics of your interest, and here I write in more detail. Also, I am present on the X account where I write regularly, so feel free to follow me. And if you want to explore more of my content and educational content, feel free to check my website. Links for everything will be in the description of this video. So this is it for today's video. I hope you like it. If you like it, subscribe and like. It means a lot. And nothing. See you in the next video. Bye.